This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
Happy New Year and welcome to 2026. Can you believe it's been 25 years since we were all worrying about Y2K? The changeover to the year 2000 required a huge effort to update computer systems throughout the world to ward off possible apocalyptic disruptions to everything from banking systems, power grids, air traffic control, billing systems, well, everything that relies on a computer. It's estimated that $300 billion was spent worldwide making systems Y2K compliant. All that work was mostly successful. There were some failures here and there, but there was no global world-ending catastrophe. There's a lesson there, I think, that's applicable to personal financial planning. Hopefully, you won't be faced with anything as dire as the Y2K situation, but it's very important to prepare, to plan for contingencies and possible unforeseen situations. Welcome to the Wise Investor Show. I'm Ann Summerson, one of the Wise Investor Group's financial planners here in Reston, Virginia. 2026 is upon us, and with the new year come new rules and planning opportunities. I'm going to spend this first segment outlining some of the changes and provide some checklist items for the beginning of the year. Then in the second segment, I'm going to introduce our newest Wise Investor teammate, Maritza Hernandez. Maritza joined us in the past summer on our financial planning team, and we'll spend some time getting to know her. I'm excited to have her here today. So the big, beautiful bill that passed this summer provided for a lot of changes. Some started right away, and some will start now in 2026. Some are permanent changes, at least as permanent as can be, and some changes are temporary. Let's review some of them, shall we? But before I get started, I want to say that any suggestions or strategies that I may mention here aren't applicable to everyone. You should consult with your own financial advisor, your tax advisor, or your estate planning attorney to see if these ideas are right for you. Now, I just said that the tax bill brought up a lot of changes, but it also kept in place many things that were in danger of expiring at the end of 2025. This includes the lower tax brackets, the higher estate tax exclusion, and the doubling of the standard deduction that were put in place by the Tax Cuts and Jobs Act of 2017. In 2025, the standard deduction will be $15,750 for single individuals and $31,500 for individuals filing jointly, married folks. In 2026, the standard deduction will increase to $16,100 for single filers, double that for married couples, $32,200. And now, for American seniors 65 and older, starting in 2025, there's a bonus tax deduction up to $6,000 per taxpayer. This deduction is subject to an adjusted gross income limit of $75,000 for single filers, $150,000 for married folks. Above those income limits, the deduction will gradually phase out and be completely eliminated once singles reach an AGI of $150,000 and joint filers reach $250,000. It's important to note that this new senior deduction is temporary. It will be in place from 2025 through 2028 only. Now, let's talk about the SALT tax deduction. Again, that's state and local taxes like state income taxes, personal property taxes, real estate taxes, etc. The 2017 bill limited the SALT tax deduction to just $10,000 for both single and married filers. Taxpayers in states with high income taxes were pretty unhappy. The new bill temporarily raises the limit from $10,000 to $40,000, and that $40,000 will increase by 1% through 2029. This is a temporary change. In 2030, the limit reverts back to $10,000. But there are AGI, adjusted gross income, phase-outs for this new $40,000 limit. If your AGI is $500,000 or below, you'll be able to deduct the full $40,000. As your income exceeds $500,000, the $40,000 will be reduced by 30% of the amount over $500,000. So once you've reached $600,000 of AGI, you'll be back to the $10,000 deduction. Now, when the 2017 tax cuts greatly increased the standard deduction, the result was a pretty dramatic decrease in the number of taxpayers who itemize. This new increase to the SALT tax deduction might swing some taxpayers back into the better to itemize column. Individuals in states with higher real estate taxes or state income taxes might find that it makes sense to itemize again. Starting in 2026, there are new rules regarding charitable deductions. First, there's a new charitable deduction available to taxpayers who don't itemize. And as we've mentioned, most people don't anymore. Single filers can now deduct $1,000 in charitable contributions. Married taxpayers will be able to deduct $2,000. This is a so-called above-the-line deduction, and this means that the deduction will lower your adjusted gross income. If you recall, we made a similar deduction during COVID. It was only $300, and it expired in 2021. This new provision with the higher amounts is expected to be permanent. Now, for you itemizers out there, there are two new limitations for deducting charitable contributions that start in 2026. First, there's a new 0.5% AGI floor that will apply to all charitable contributions. What does that mean? Well, only the portion of your charitable contributions that exceed 0.5% of your AGI will be deductible. So, for example, if your AGI is $200,000, the first $1,000 of contribution, $1,000 is 0.5% of $200,000. That only the contributions in excess of the $100,000 will be deductible. So obviously, the higher your AGI, the less your contributions will be deductible. And there's another limitation that will affect high earners. Starting in 2026, taxpayers in the highest tax bracket, 37%, will see the value of their itemized deductions capped at 35%. And this is going to apply to all of your itemized deductions, including the charitable contributions. And again, these new limitations start this year, 2026. Remember that qualified charitable distributions from an IRA remain a very tax-efficient option to give to charities. QCDs, while not deductible, do not count as income. Anyone can make a QCD once they've reached the age of 70 and a half. And once you are of RMD age, which is either 73 or 75 at this point, based on your current age today, then a QCD can fulfill some or all of that required minimum distribution. And again, it's not taxable. The amount of QCD that an individual can make will be $111,000 for 2026. Now I'm going to switch over to a change to the use of 529 college savings accounts that came about with the tax bill last summer. The change hasn't made much press, it's not received much notice, but I think it's important. Until a few years ago, the use of 529 college funds were limited strictly to college or trade school. In 2017, the Tax Cuts and Jobs Act allowed for $10,000 per year to be used for private secondary school tuition. Last summer's tax bill expanded that even further. First, it doubles that tuition allowance to $20,000 per year to be withdrawn for private school tuition. But in addition, 529 funds are now available for a much wider range of kindergarten through 12th grade expenses beyond tuition. This includes tutoring, textbooks, test prep materials, homeschooling materials, online learning resources. You'll also be able to use the expenses related to special education needs like speech therapy, occupational therapy, and adaptive learning software. In addition, you'll be able to use 529 funds for post-secondary credentialing expenses, the so-called non-traditional education. You'll be able to use the funds for apprenticeships, certificates that are awarded by education institutions or industry organizations. You can use it for professional licenses, continuing education fees. It's really a big expansion. And remember that the ability to roll unused 529 money to a beneficiary's Roth IRA remains in place. You can roll up to $35,000 during the beneficiary's lifetime, subject to annual contribution limits, of course, provided that 529 account has existed for 15 years. All right, let's now talk about retirement plan limits for 2026. The contribution limit for traditional and Roth IRAs has increased $500 to $7,500. The catch-up provision for people 50 and older has also increased. It's now $1,100, up from $1,000. So if you're 50 or older, the maximum contribution is $8,600. Remember that anyone with earned income can contribute to a traditional IRA. Whether you can deduct that contribution depends on your adjusted gross income. To get a full IRA contribution deduction in 2026, your AGI will need to be below $81,000 if you're single, $129,000 for married filers. If you're over that limit, you can still make a non-deductible contribution. Just make sure to file an 8606 tax form with your taxes to document the contribution so you don't have to pay taxes on that amount later when you start distributing the account. Now, Roth IRAs grow tax-free and are not subject to required minimum distributions. They are so desirable that Roth IRAs have adjusted gross income limits, which prevent higher earners from making direct contributions at all. Single filers are completely phased out of making a Roth contribution at $168,000 for 2026. Married folks, it's at $252,000. Now let's talk about work retirement accounts. First, the contribution limits have gone up. 401k, 403b, thrift savings account, etc. The limits have increased $1,000 to $24,500 for 2026. If you're 50 or older, the additional catch-up has increased $500 to $8,000 for a total of $32,500. And new for 2025 and continuing on, there's a super catch-up for people who are 60 through 63 years old. That additional amount is $3,750 for a total catch-up of $11,250. So in 2026, if you are those ages, you'll be able to defer a total of $35,750. All right, we're used to getting contribution limit adjustments every year, but this is new. New in 2026 is a change to catch-up contributions for high earners. Starting this year, if you are deemed to be a high earner, your catch-up contribution will be required to go into your company's Roth 401k account. That's right. So that extra $8,000 will be contributed after taxes, not before taxes, like a traditional 401k salary deferral. You'll be considered a high earner if your prior year wages exceeded $150,000. This will be determined by your W-2 that you get from your employer. If box 3 on your W-2 is more than $150,000 in 2025, you'll be considered a high earner for 2026. That $150,000 number is going to be indexed for inflation yearly. Note that your AGI has nothing to do with this new provision. No one is going to look at your tax return for this, only your W-2. And currently, self-employed individuals are exempt from this rule. Now, most companies have Roth 401k provisions. If yours doesn't, then you won't be able to defer the catch-up amount. If you don't have a Roth provision, then I think it's time to ping your human resources folks about adding it. Now, on the surface, this new catch-up Roth requirement might seem annoying. I'd like to suggest that it's really not so bad. Personally, I think it makes a lot of sense to contribute to a Roth 401k no matter your income. Even if someone is in a higher tax bracket, today's tax rates are low from a historical standpoint. No matter what your politics are, it's not hard to imagine higher tax rates in the future. So it's probably a good idea to make Roth contributions where you can pay the taxes today at a known rate rather than deferring and paying at an unknown rate in the future. And even if you assume taxes stay the same, you might consider diversifying your future tax liability. If you can spread out the taxability of the accounts that you save into, then you'll have options when it comes time to draw on those accounts in the future. So even if you can't contribute to a Roth IRA directly because of your adjusted gross income, if you're still working, you can choose to contribute to a Roth retirement account there instead. All right, those are some of the new limits and rules going into effect this year, 2026. When I come back from the break, I'm going to be joined by our new financial planner, Maritza Hernandez.
AI stocks still dominate the market, but valuations are almost back to dot-com bubble levels. How should you balance participation with diversification? Tune in every week as we discuss the latest financial trends and how to become a better informed, wise investor. Listen to us at The Wise Investor Show at raymondjames.com/The Wise Investor Group, or just find us on your favorite podcast app. Raymond James Financial Services Incorporated, member FINRA SIPC.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.
Welcome back to the Wise Investor Show. Well, we've just covered some big changes coming in 2026. Now, I'm excited to shift gears and talk with someone who helps clients navigate these changes every day. Maritza Hernandez, our newest financial planner with the Wise Investor Group. Maritza, thanks for joining me.
Thanks, Ann. I'm so glad to be here.
I'm so glad you are here. Let's start with your story. First, tell me a little bit about your background. Your family moved here from Puerto Rico, right?
We did. I grew up in a small town on the west side of the island. Growing up there was really special, but resources are limited. Electricity and water go out unexpectedly. There are not a lot of jobs and definitely no high-paying ones. And to this day, if you can believe this, you cannot get high-speed internet in the neighborhood that I grew up in.
Oh my gosh, that's horrible.
It's crazy. My parents wanted better opportunities for my sister and me, so we ended up settling in a small town in Pennsylvania. I attended ESOL classes for 2 years to learn English, so those were really my early days. They taught me a great deal of resilience and adaptability.
I know, and I think you told me before that you had moved here when you were 12 and didn't really speak English until then. And I've been amazed I didn't know that you spoke another language when you first came.
Thanks, that means a lot.
What inspired you to pursue a career in wealth management?
I wish I could sit here and say that I always dreamed about being in wealth management, but honestly, I didn't really know this field existed for most of my life. My parents have lived paycheck to paycheck most of their lives, and I worked full-time to put myself through college. I like to say that my career is really a mix of hard work and luck. I didn't plan on the path, but once I started, I realized how much I love it. The blend of technical expertise and human connection is what inspires me every day.
So my path to this business is somewhat similar to yours, different also, but I also didn't know about this business when I was just starting off in my career. I had no idea what it was. I didn't get into financial services until I was in my late 30s. I had spent my early career in sales in a couple of different industries. And one day I went to a job fair and decided to make a change. They didn't even call it wealth management back then. Everybody was still a stockbroker. The shift to include financial planning in the mix was just getting started. Was there a defining moment that made you realize that this was the right path for you?
One particular moment sticks to mind. I was working with a family who had unexpectedly lost their husband and father. So we worked together to navigate the next steps. I saw firsthand how working together brought them peace of mind and clarity during that very difficult time. That experience made me realize that our work isn't just about numbers. It's really about people, their goals and values, and creating a sense of security. It clicked for me that I could make a real difference in someone's life, and that's when I knew this was the right path.
You know, I too have felt like I have made a difference, that I've helped people over the years in financial planning, and it's very satisfying to me. So Maritza, you've spent 10 years at another firm before joining us here at the Wise Investor Group. What motivated you to make the move?
For me, it was about a client-first culture and the flexibility to continue to enhance my craft while also balancing my personal responsibilities. I love what I do, and I get to geek about it all the time. I wanted to continue to raise the bar in terms of my knowledge and the experience I could provide my clients. At the same time, I am a relatively new mom. I wanted to work with a team that understood and respected that. At the Wise Investor Group, I have the freedom to create personalized strategies, which are critical for high net worth clients.
So, what's been the biggest difference in how you work here now and the way you used to work at your old firm?
The biggest difference is flexibility and personalization. With the Wise Investor Group, I'm not confined to a rigid one-size-fits-all model. The freedom allows me to be more creative and proactive. Another big shift is the emphasis on collaboration. Our team really works as a team instead of a siloed partnership.
We really are a team, aren't we?
Yes.
I mean, it's a big team that we're very proud of.
It's beautiful to see. Yes. So we get to work holistically across tax, estate, and investment planning, which means clients get a more integrated experience. It's more of a relationship-driven approach, and that's what I love.
So you just mentioned that you're a relatively new mom. Balancing a demanding career and family life isn't easy. How do you manage it, especially as the mom of a toddler who's just entered the terrible twos?
I've learned to prioritize ruthlessly. I also lean on technology a lot. Calendar blocking and automation are lifesavers. And honestly, giving myself grace when things aren't perfect.
You just mentioned all the technology that we have now. It is pretty amazing. We didn't have much of it at all when I started off, so it's a big improvement. Any productivity hacks that you have for the listeners and me out there?
I would say a mindset tip that has made a difference for me is adopting a progress over perfection mentality. So perfection would often paralyze me and delay my workload, really procrastination. But progress, even at small amounts, will compound over time. That mindset shift has helped me feel a lot less overwhelmed and get to build momentum.
That's good. I like that. Not worrying about being perfect, just making sure that everything gets done. So I just spent the first part of today's podcast talking about upcoming tax changes in 2026. What planning opportunities do you see for our clients?
Roth conversions are a big one, getting to lock in today's tax rates before any future changes. Also, leveraging donor advised funds. Clients get to accelerate deductions when they are philanthropically inclined. This strategy helps offset the new 0.5% of AGI deduction floor that's coming into 2026, which you mentioned earlier in the podcast.
Yeah, so Roth conversions are certainly something many people consider. We've been doing these for years. A lot of people retire and they end up with lots of money in tax-deferred accounts from their jobs. So we're many times talking to people about converting to the Roth. You mentioned something about donor advised funds. Can you tell me a little bit more about those?
Absolutely, I would love to. Donor advised funds are one of the most flexible and tax efficient ways for individuals and families to manage their charitable giving. Essentially, it's like having your own charitable account. You make a contribution, which can be cash, securities, or even complex assets. You receive an immediate tax deduction, and then you get to recommend grants to your favorite charities over time.
So you get the deduction now, but you don't have to pick the charities until later. Is that how it works?
That's exactly right. Donor advised funds separate the timing of the tax deduction from the actual charitable gift. So if you have a high income year or a liquidity event, such as selling a home,
or maybe selling your business,
you can make a large contribution to the donor advised fund, lock in the deduction, and then take your time deciding which organizations to support. Plus, a great benefit is that the funds get to be invested and potentially grow tax-free, which means more impact for the causes you care about.
Great. So you and I have talked about behavioral finance some. I personally find the whole area very interesting. It's essentially the idea that investors aren't really perfectly rational. We're all affected by psychological influences and emotions. We all have cognitive biases that affect our decision making. How does behavioral finance show up in your conversations with clients?
Behavioral finance plays a huge role in my day-to-day. We get to see that money decisions aren't just about math. They're really about emotions and personal experiences. Clients often come in with fears, habits, or mental shortcuts that can influence how they view risk, how they spend and invest.
They can be their own worst enemy, right?
Unfortunately so. Someone might hold on to a stock because of loss aversion, even when it no longer fits their goals, or they might chase trends due to herd behavior.
So loss aversion would be, I've had this forever and I can't let go. And herd behavior is, well, everybody else is doing it, so I have to do it too, right? Everybody else owns the stock and I can't sell it.
We see it all the time. So our job is to recognize those patterns, to bring awareness to our clients, and to help them move forward towards decisions that align with their long-term objectives, not just what feels good in the moment. At the end of the day, understanding the psychology behind money helps us build trust and create strategies that clients can stick with even when markets get emotional.
So what trends in wealth management excite you the most right now?
Artificial intelligence, Ann.
Really? AI? Wow.
I know, shocking. AI is really transforming how we analyze data, how we personalize advice, and manage risk. It's not about replacing our human judgment, it's about enhancing it. By automating routine tasks and surfacing actionable insights, AI frees us to do or focus on what matters most.
So AI, in your opinion, is not something we should be afraid of?
I personally don't think so. I think AI is a tool, and like any other tool, its impact depends on how we use it. Rather than fear it, we should focus on understanding it and using it responsibly. I like to think of AI as an assistant that makes us more efficient, not a replacement for what makes us unique as advisors.
Maritza, you have been with us about 6 months now. What do you think sets our team, the Wise Investor Group, apart?
As a team, we put financial planning at the center of every conversation, not just the investments. One example is our use of advanced tax planning technology. Our tool allows us to instantly analyze a client's tax return and model strategies, such as Roth conversions, charitable giving, or tax-efficient withdrawals. Instead of generic advice, we deliver actionable insights tailored to each client's situation.
So this new tax analysis that we're providing is really great. It lets us incorporate clients' tax brackets. We consider where they might fall in the Medicare Part B surcharge brackets, all sorts of things. And then we're able to model, like you said, Roth conversions and other scenarios. Maritza, I get the feeling that you feel education is an important part of your job. I know I certainly feel that way. Why do you think it's so important for clients to understand their financial plan? Heck, it's so important for them to have a financial plan to begin with.
When clients understand their financial plan, really look at how each piece fits together, they're less likely to react emotionally to short-term market swings. It turns uncertainty into clarity. I see my role as empowering clients to make informed decisions, not just following advice blindly. When they really grasp that why behind strategies like tax planning, asset allocation, or estate structures, they feel an ownership over their financial future.
Right, so this has been fantastic. Any final piece of advice for listeners as they prepare for 2026?
Start early. Tax law changes create opportunities, but timing matters. The sooner one can plan, the more options we have.
I couldn't have said it better myself. Thanks for joining me today, Maritza. Well, that's going to wrap things up for us. Simon Hamilton will be back with you next week. Happy New Year, everyone, and I wish you wise investing.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.